So let's start with this. The 30-year mortgage is absolutely costly, okay? And in several ways, but let's talk first about just monetarily, it's costly, okay? So if you take the 30 versus the 15, so we're going to do this example of the 30-year mortgage versus the 15-year mortgage. It's a very common example that's run. And let's say it's a $200,000 mortgage, which is the U.S. median house cost, right? It's 4% rate. Both are 4% rate, which typically 15s have lower rates than the 30s. But we're going to say, for example's sake, they have the exact same rate. And then we just do 30 versus 15 years, right? Well, the payment difference, first off, obviously the 15 is going to have a higher payment because you're paying off the exact same amount of debt in a shorter period of time. So you have to make a higher payment. So the 15 year is going to have a $1,479.38 payment, okay? And the 30 year is going to have a $954.83 payment. So obviously you're going to pay more month to month with the 15 year, which is the deterrent for a lot of people. But if you hear the rest of these numbers, you're going to be like, I want to do the 15 or less than the 15. Like, I don't want to do a 30. All right. The total cost to pay off for the 15-year mortgage is $266,287.65. Okay, so you paid $66,287.65 in interest. Now, with the 30-year mortgage, remember the exact same mortgage amount, the exact same house we're talking about here, but just on two different mortgages. Okay, with a 30-year, you would have the total cost of $343,739.01. So that means you paid $143,739.01 in interest. The difference between those two is approximately $77,500 in difference. That's the difference in cost between the 30 and the 15. That is a huge cost. For most people, that's a year's of household income difference. And that's substantial. But then if that doesn't motivate you enough, if that doesn't make you believe that the 30 year is too costly, then let's move to the opportunity cost of the 30-year mortgage. So what I mean by opportunity cost is the next best alternative that you're giving up. Okay. And so what would be an alternative to paying on your mortgage? What would be something that you give up to continue paying on your mortgage? Well, naturally, my mind goes to increasing the amount that you would invest. Because if you didn't have a mortgage, then you could naturally invest more money. So you could be investing the mortgage payment. And if I were to have paid off that 15-year mortgage that we were just talking about, and then invested only half of the payment, which the payment was almost $1,500. So I said $750 invested. If I just invested half of that payment on a monthly basis, and I did that for 15 years at 8%, that's an extra $259,528.67 that you have invested for you for the long term. That is a large amount of money, and that's just assuming an 8% rate of return, and that's just assuming that you only invested half of that payment. That is a huge amount of money that you are foregoing to continue paying on a mortgage. That's crazy. And then for the sake of financial balance, let's not forget that we have two other ways that we are giving something up in order to stay paying on this particular 30-year mortgage. And those two things we're giving up is we could be giving that payment. We could be being generous with that payment. We could be making a bigger impact but with our giving from that house payment that we did have on the 15. We could be doing that. We could be spending the payment on, experiences for our family, on doing things with, kids, and doing things with your spouse, and just going and enjoying, the world, traveling the world by yourself even. So this just shows that the 30-year is so costly. And, a 30-year mortgage will likely take on the entire childhood of your children. So if you were just to pay a 30 like a 30, then it will take up most of your child's life, right? But a 15-year mortgage or less won't. It may take up a good portion of, let's say you bought a house as soon as you had your first child. Well, then 15 years later, they're 15 years old. Well, you've still got a few years in the house with them. Then you may have younger children or whatever. So you can actually use that extra money on them. You can actually do things with them and take them on trips and give them experiences because you had the extra money to do so. But if you're just paying on a 30, you're never going to really get that chance. Then the 30 is also costly because it takes a long time to build equity. I mean, early on within a 30-year mortgage, most of your payment is going straight to interest, and you're not really making any headway on the principal balance of your home. And so it's just really hard to build equity. So if you sell after even 5 years in a 30-year mortgage, you're not going to get to net much from that home. But if you sell after 5 years in a 15-year mortgage, you can actually profit a good amount and then roll that into your next home. And then the last cost that I want to talk about is something that is more emotional, but it's the cost of freedom. And like I've said previously, when you borrow, you are enslaved to the person who lends to you, right? You are in bondage to debt, right? Because you have to pay them or else they're going to ruin your life, okay? We're in bondage to debt. And even if I say I'm okay with the mortgage, which I am okay with a mortgage, right? Then I still want it paid off quickly. I don't want to be sitting in it for 30 years of my life. That is so long. Like we talked about at the beginning, I can't fathom staying in bondage to debt for that long. And you simply just don't have the options when you have a mortgage that you do when you don't have a mortgage. So paying the mortgage off earlier is better, and the 30 is just not going to get you there. The 30-year mortgage is not the way to get you to having financial options and being financially free. The way to financial freedom is past investing at least 15% of your income, pound away at the house. Pay as much more of your discretionary income on the house as possible and get that thing paid off. And then you have so many options, so many ways that you can just move forward financially in a place of financial strength.